Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, July 30th, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. The rest of this week's going to be kind of interesting. We kicked off the latest Fed meeting this morning. We'll get that announcement tomorrow at 2 o'clock. I'd still like to think that they're going to cut rates, but I don't think they will. I think they're going to talk about it. I think they'll say that things are setting up for a September cut. I think they'll continue to remain data dependent. That's one of Fed Chief Powell's favorite phrases, data dependent. So we'll see what's going on. I don't think they're very dependent on the actual chart of inflation and what's happened over the last 2 to 3 years, but they do remain data dependent. I just chuckle a little bit, but it's really no laughing matter if you look at what's been going on in the economy over the last couple of months. Some look at the GDP and say, well, everything's fine. But problem is you're looking at the GDP in reverse, what has already happened. I think some of the signals that talk about the future are starting to show some cracks in the foundation. And I think those are the ones that the Fed needs to address and start cutting rates now. We'll see. Got some big earnings reports coming up this week. We've got Microsoft coming up this evening after the bell, along with Advanced Micro Devices, Starbucks, which will give us a little bit of maybe a taste of what's going on in the consumer space with that Starbucks report. Apple's coming out later this week. Meta's coming out. Amazon. We got some big reports that certainly can influence the market one way or another. I'm going to be very interested to see how these big companies, not only report, but how they trade after their report for the next couple of weeks, because I do think that we have a window of an opportunity here for a bounce in the market. We saw a little bit of bifurcation yesterday. We'll talk about that in just a minute. But we did see some of the tech names bounce a little bit. Some of the big large cap NASDAQ 100 names. I know Tesla had a pretty good day. But it still wasn't quite that, the feeling wasn't that strong about that move. And we saw it deteriorate a little bit throughout the day. Small caps, which led for the last 2.5 weeks, took a day off. We saw them underperform the NASDAQ 100 and the S&P 500 by a considerable margin, about 1% or more. But keep in mind that the small caps, the IWM, had outperformed the QQQ by about 18 percentage points in the prior 2.5 weeks. So giving back 1% certainly is no big deal, but we'll want to see if that continues or if the small caps make a breakout above a key level up near 225 on the IWM. So we got all that going on. We got jobs coming up. We got Wednesday, the ADP employment report tomorrow morning. That'll be out just before the Fed announcement. And then on Friday, we have the non-farm payrolls for the month of July. What is that going to say? Remember, June came in stronger than expected. Do we get another jobs report that's strong? Because that would certainly be conflicting data on exactly whether or not the economy is slowing or not. So a lot going on. The market's going to have to decipher it. I do think that the message that's been sent from the bond market is please cut rates, Fed. And so right now we're just waiting. We're going to wait and see what the Fed has to say with all the data that they've looked at over the last, I don't know, however many weeks it's been since their last meeting. And we'll see what path they take and how the market reacts to it. If they talk about cutting in September and the market sells off, I don't know. It would seem to me like the market's sending a pretty clear message that they've waited too long. If, in other words, or on the other hand, if they were to say that we're cutting and we see a big rally in the market, maybe the market's still holding out hope for a soft landing. I'm kind of on the fence. I'm not sure. I'm not really trying to decide. I'm going to let the market help me decide. So I'll just sit back and watch the action for now. Let's go ahead and take a look a little bit at what happened yesterday. I just got this quick market overview that stock charts provide. So let's just zero in on these numbers. So Dow Jones Industrial Average yesterday down 49 points, still over 40,000. 40,539 was the close. S&P 500, you can see actually was up less than 0.1%, but up is up. NASDAQ, same thing, up less than 0.1%, but up is up. Small caps down about 2/3%. So actually the S&P 600 small cap index, which is different look than the Russell 2000, but the S&P 600 small cap index fell less than 10 points, or about 2/3%. Not that far off the S&P and NASDAQ, less than 1%. Mid caps did even better. It did drop. That group did drop 5 points, or about a little less than 0.2%, but not too far off what we saw with the S&P 500 and the NASDAQ. The VIX 1660, so we have pulled back down below that 17 level, which is good, but we did have a little bit of a bounce yesterday in the VIX, even though the S&P 500 did climb. So the VIX will be worth watching, because as that rises, we see more volatility. That means that the market makers are expecting more volatility ahead, and that usually results in downward action in the stock market. So the VIX, a far cry from where we were just recently, down around the 11-12 area, now up at 1660. And as you get closer and closer to 20, that kind of is the turning point for me in the market. If you get above the 20 level on the VIX, I think it's time. No matter what you think about the market, I think you got to be really careful with a VIX that's above 20. Historically, that is where we have our biggest drops in the S&P 500. So keep all that in mind. We're really not that far off of the all-time highs at this point, with the VIX up 16. Recently, we got up to around 19. But you get through 20 and some of the losses can mount very quickly. So just keep that in mind. All right, 10-year Treasury yield. Currently, let's get the latest here, get you that update. 4.16. So we are getting close to what would be lowest level since maybe the second week of March. If we take out that 415 area to the downside. In terms of economic reports, not really anything out this morning. I mentioned that the Fed meeting has started. We do have a couple of home price indexes that will be out this morning. Actually, Case-Shiller just came out, and it showed, well, this is way in our rear view mirror, by the way. This is May data. So we're talking about the prior month, which would have been April, rose 0.4%. And the consensus for May was 0.5%. It actually rose 0.4%, so a little less than expected. Not really anything major with this report, especially the fact that it's all the way back in May. I think now we're getting ready to go into August. That's quite a ways back. And some of the other signals, like I said, GDP was stronger in Q2 than Q1. But what's going to happen in Q3? What does the market think as we move forward? And that's going to be one of the critical themes, I think, in Q3 is, do we get that? Do we start to see more of an economic slowdown? Because I don't think inflation's a problem anymore. There are some that want to argue, and that's fine. I'm just looking at the charts. Charts are telling me it's not a problem, so I don't believe it's a problem. I mean, could it resurface or surge back to the upside? Of course, anything could happen. I don't think it's going to happen. And I think if the Fed talks about cutting rates, they don't think it's going to happen. I think the bigger problem is the economy. And that's where we're going to have to kind of watch these charts and just see if on the charts we're seeing any further deterioration. Either way, whether we're having a slowdown or if inflation's going up, it's not good for growth stocks. So either of those two scenarios would not be good. But I think the latter, having issues with the economy could be, where the market falls and what it's based on in Q3. So in addition to the economic reports, by the way, that are out later this week, and the Fed, when these companies report, it's not going to be so much what'd you do last quarter. What's your guidance? What do you see in the quarter ahead? Are you starting to see a slowdown? Those are some questions that need to be answered. And hopefully we'll get some of those answers this week. S&P 500, made the move up. We've pulled back to the 50-day moving average. So on the daily chart, you might think, okay, well, maybe this is it. And it might be. Sometimes the daily chart gets down to around that 50-day. We saw it back in late May, bounced right off of it. We went a little bit below in the April weakness, bounced right back off of it. And prior to that, it was nothing more than 20-day tests. So we are in an uptrend. Technically, we pulled back a little bit of an ABC move. First move, we went down below the 20. We came back up above the 20, and now we went down to the 50. So on a daily chart, this is like a little ABC pattern. Maybe this is it. It's possible. I don't think it's likely, but I think it's possible. I don't know what the odds I would put on that are, but PPO back down near the center line, price action at the 50-day. I mean, if you go back in history, I mean, that's pulling back quite a ways. That's giving us a little bit of relief from all the overbought conditions we saw just a few weeks ago. NASDAQ 100, a little bit more deterioration here. And if you notice, I'm going to point this out. I don't know if you've noticed or not. First, let me shorten this to a 6-month chart just to make it a little easier to see. Now let's annotate. And right here, what's that look like maybe? An uptrend is made up typically of a series of higher highs and higher lows. So the first sign that you could be seeing something a little different in the market is when you go back and you don't have a higher low. You go back and you test the low. That's no longer an uptrend. Now you've got a little bit more of sideways consolidation because your lows are the same as the last low. What's even maybe a little bit more bearish, if you will, I mean, I would just say cautious, because in secular bear markets, I generally don't look for bearish patterns to execute. But it is kind of interesting to see that this one did execute. We got a topping head and shoulder pattern. So here you got the, might as well just label it all for you in case some of you maybe are not familiar with patterns. But that looks to me like a head and shoulder breakdown right here over on the right side. That right there. Volume picked up. We lost that sideways action. It's no longer sideways action. We broke down. And so what I look for, having already seen this, and so this is a technical sign that this isn't the same as what we've seen recently. This wasn't the 20-day pullback. I mean, this is a little bit deeper and maybe has a little bit more in terms of a lingering effect on the market as we go forward. But what I look for when we get a breakdown out of a head and shoulder pattern is a movement back up to test one of two areas. The first area would be the actual breakdown itself. So we broke down on the NASDAQ around 19,450. And so looking back up at 19,450, if we rally to there, that would be the first level maybe to look for a reversing candle. The second one would be, sometimes we get through that neckline, and this comes from years of experience, because I used to always look for a move to the neckline, and then I'm like, okay, if I'm going to short, that's where I want to short. If we had an inverse head and shoulder, which would be the other way off of an uptrend, you come down, put in the left shoulder, you go back up, put in the neckline, head, back up to the neckline, right shoulder, and then break out. Either way, I used to always think, okay, when you break down, you go back to that level. And if you get through it, that's a really, in this case, would be a really bullish sign. And as I've gotten older and made some mistakes and lost some money, I've realized that declining 20-day moving average is also a key level to watch. So when I talk about resistance, I'm going to give you a little range here from about 19,450 to that 20-day moving average, which right now is at 19,604. So 19,450, 19,604. That gives you about 150-point area, where if we get back up into that area, be careful, because that might just be all you get to the upside before another swoosh to the downside. Maybe it's a little bit of, we move up here and we go sideways, but we stay underneath that 20-day moving average. Maybe it's the middle part of August before we get that swoosh. But if we're going to see some strength in the near term, I kind of like getting back up into that area first, and then see if the market has any staying power to see if we can actually get back through both of those levels. That wouldn't exactly be, hey, we're out of the woods, we're going back to all-time highs, but it would start to tell me maybe this is going to be more sideways rather than a big downtrend. So that is why I'd be watching those two levels. The IWM, we gapped up, actually gapped up to a new either opening or closing high yesterday. So the small caps had a chance to make a big breakout and run yesterday. Instead, right from the get-go, I mean, we gapped up, we went a little bit higher, and then it was pretty much down most of the day. I'll show you a 5-day, 10-minute chart. So here was the move up. Here was the gap open. We came back down, basically filled the gap. And then we went back up and it looked like, okay, here we go. Over 225, got to a high of 225.42. That didn't hit the intraday high we saw recently, which I think was around 226. So if you look at it from an intraday basis, we never did break out. Pull up this chart. Yeah, right here, 226 and change. I don't know if we got to 227. 226.64. So yesterday we did make a breakout in terms of closes or opens, so candle body, but intraday we still had some work to do. We still fell probably a little over $1 shy of the high that we set back on July 16th late in the day. Now, as I look at this on this monthly hourly chart, or 1 month hourly chart, I should say, we had gap support. I think that would be the first key level to watch to the downside on the IWM. That comes in right at about 220.5, something like that. So watch that level. Yesterday, we got down to 220.77, but we did bounce into the close. And let me give you the futures. Didn't give that to you yet. Diamonds, which track the Dow Jones, down 0.05%. So basically flat. The Spider tracking the S&P 500 up 0.25%. The QQQ tracking the NASDAQ 100 up 0.33%. And the IWM, which tracks the Russell 2000, the small caps, up almost 0.5%. So up $1 to 222.78. So we are moving back up, at least pre-market. We'll see what happens once we open. We may have another gap up and maybe failure like we did yesterday where we come right back down. We do right now have a pattern starting, because we closed near the low yesterday. If we go back down and go below yesterday's low of 220.77, we could be starting a little bit of a pullback into maybe a little bit more of a downtrend on the IWM. Short term, what I would do here is I would be watching probably 216. That was the low when we pulled back on July 18th, 19th. And then to the upside, the intraday move was 226. I still think somewhere around this 225 level, like maybe right in here. I think that's kind of the closing area. Remember, where we went up above this back on July 17th, we opened below it. We had an intraday move in the morning, kind of like we did yesterday, where we got up to 225 and change. And then we fell in the next hour. We couldn't hold it. So closing above about 224.50 to 225 is what I would look for to the upside on the IWM. Downside 216. And that would be off of an uptrend to have sideways consolidation. Another breakout is what you would expect out of that. But we haven't broken out yet. So, you can assume that it's going to happen, but it still needs to confirm. The other thing I would maybe watch kind of closely is what I was just talking about, that recent low. So let me give you this gap support area right here. Kind of even hard to see it. Make it a little thicker. There you go. So right around this level, 220.5, something like that, is a level to watch. If we close back below that, then you can see a couple other levels to watch, 218. And then ultimately, I think 216 is going to be a pretty big level. So if we look back at a daily chart, look at the 20-day moving average right now. 20-day moving average is at 215.08 and it's climbing. So when I talk about that 216 support, holding on to 216, keep in mind, we've got the 20-day EMA right at 215. So that area becomes really big support on the downside. A couple of different ways I could see this going off of this move to the upside. I can kind of see equal highs. Maybe we pull back here and we're putting in one more higher low in this ascending triangle. I think that's a possibility. I think this is a cup. This pullback could be a handle, which on a breakout would measure up another $10, which, by the way, would be the next key resistance level if we go back further on the chart to 235. So if you play it either as an ascending triangle or as a cup with handle, both of those on a breakout above 225 would measure to 235. So, the patterns are lining up. Even if we go sideways, come back down to 215, 216, this area. Again, that sideways consolidation is $10. Breakout above 225 measures 235. So we got a lot of different bullish signals, but bullish patterns that on a breakout would all measure up to 235. And when we moved through 210, 211, that was my call, was that I thought we would go up to 235. So I think short term, we're having a little hesitation. I do think the IWM makes this move. It's not a guarantee. It's certainly not 100%. I'm not 100% sure, but I would probably put the odds of breaking out and going to 235, say over the next few weeks. I think it could be in the neighborhood of 60, 70% chance. Maybe higher. We got to get the breakout. The breakout's the key. Once we get the breakout, then I would probably up it to maybe 80% that we're going up to 235. All right. Keep moving on. We got the transports. Transports look great along with the small caps and all of a sudden fell apart. But hey, we've been kind of grown accustomed to this, right? I mean, we've seen this with the transports for a long time, except this time we're actually coming back up again, and a breakout above 16.3 would be really bullish for this group. So this would start to signal to me that we've held the rising 20-day and we've broken out. Every other time we've gone up, I mean, if you go back and you look, every other time we've gone up, we've either failed on the way back down to 20 or we've held it, but we couldn't get back through a new high. And that's been the story since this uptrend began, really back at the end of October. Once we made that initial push, it's been a very, very frustrating ride, excuse me, on the transports. This one looks good, but we got to make the breakout. Now, if you make a breakout, the transports, what's that telling us? That actually, normally when you're expecting future economic growth, you would see transports breaking out. So it'll definitely clearly give us a mixed signal if we're seeing the growth stocks going down, acting as if maybe we have a recession on the horizon, and yet transports going up. But there could be something else at play here, because when the economy was strong, transports weren't going up. So it's really been weird. The whole cycle off of the October 2023 low for the transports, I think, has been very strange in the way that they've traded. They really don't corroborate any other stories that I'm trying to tell about the market and what the charts are telling about the market. So I do know, though, historically, it would be a good thing to have transports moving up. So I'd like to see that breakout above that 16.3 level. All right. If you're new to Earnings Beats, welcome. This is my home right here at Earnings Beats. If you go over to earningsbeats.com, you can scroll down a couple things. Number one, we do have a 30-day free trial. So you can come on board, check out our 30-day free trial. We had a big event on Saturday. If you do sign up, write in, ask for, if you don't get a copy of it, write in and ask for the recording for that event. It was a members only event, but free, no cost 30-day trials also qualify for that as well. So check us out. Take us up on a 30-day free trial. You will not be charged until after your 30-day period is up, and we will remind you that your 30-day period is coming up. So anyway, check that out. And while you're there, you can, for 30 days, kick the tires, see what we do at Earnings Beats. I think you'll really like it. And also, by the way, from Saturday's webinar, we did have an annual member special that expires as of midnight tonight. So today would be a good time to check out the service, look around. And if you do like it, and you've been following me for a while and you like our approach at Earnings Beats to the market and to trading and our educational approach, you could take advantage of that annual special. So, and that you can click on here and check out the webinar special if you'd like. We also have a free market history download. If you haven't downloaded this, I have no idea what you're waiting for. This is a lot, many hundreds of hours of research that I've done over the years, for the past 25 years, probably. The history I've done, what I've worked on dates back all the way to 1950. So it's 75 years of market data. And a lot of people might think that stock market doesn't, the history of it doesn't repeat itself. I would completely disagree. I see stock market history repeating itself all the time. So having this history and knowing the history will help you, period, as far as you trading in the market or approaching the market. It's free. Download it. And then also scrolling down, you see you have an area where you can sign up for our free newsletter. This comes out twice a week, Mondays and Wednesday mornings. It's a chart that I like. I gave you one yesterday that I think could be one of the better stocks going into its earnings report. They report tomorrow after the bell. Tomorrow morning, when I send out another EB Digest, it's probably going to be earnings related. I'll give you a stock that I either like or I don't like heading into their earnings report, which also will probably be coming up either later this week or early next week. But anyway, it's free. Check us out. I think you'll appreciate our approach and hopefully learn some things to put into your trading arsenal. All right, let's keep moving. So as far as the chart for today, what I thought I would do is pull up on semiconductor, because yesterday it tried to make a breakout. And when I look at individual stocks and I'm trying to decide, when they're breaking out, do I buy them on that breakout? What's a good breakout and what's not? Well, when I look at on semiconductor, first of all, think about semiconductors. They've been horrible since the middle part of June. So we've been going on now for somewhere 5-6 weeks or whatever with a very weak semiconductor group. So when a semiconductor stock is trying to make a breakout in the midst of a very, very poor industry group performance, I'm going to hesitate. When a stock is trying to make a breakout, an individual stock is trying to make a breakout with a very weak AD line, I'm going to hesitate. And when a stock is trying to make a breakout and it has had this kind of relative weakness versus its peers for the last year, I mean, yeah, we're showing a little bit of strength here over the last couple of days, but is this just a little bit of a bounce? When I'm showing mostly weakness, relative weakness, and I see a breakout in an individual stock, I'm going to hesitate. I'm not going to pull that trigger. Number one, I have to see it confirm. I'd have to see it confirm. Did we confirm on the close yesterday? No, we did not. In fact, here was a rally off of this low. We had this rally. Guess what? We went up. We had an intraday high above it. Couldn't handle it. Went right back down. And then more recently, we came up, broke out above these two highs. Look at the volume. You see any spectacular volume down here? Because I see less than average volume on this move to the upside. Less than average volume on a stock breaking out is not something I would be excited about, especially one with an AD line that's weak and that relative strength is weak. And once again, what did we do? We failed. Look at this last high right here, July 16th. The volume right there may have been the lightest volume or one of the lightest volume days we've seen on this stock maybe all year. And there it is, making a breakout. You're going to trust a breakout on the lightest volume of the year or close to it? Poor AD line, poor relative strength. No. Down it goes. Look at the volume. Picked back up on the move down. Now here we got volume picking up. We got a gap up. We tried to break out, but we failed. Came well off that high. So we got a little bit of a pop in the AD line. We'd have had a much bigger pop in the AD line, and this chart would have looked a lot better had we closed above the breakout level. So right now, to me, all we're doing is just testing resistance in a stock that is showing distribution and has been a relative laggard. I got to see a lot more from this stock. I definitely, if I had bought this stock yesterday on the breakout, I would have sold it on the close after failing to hold the breakout. So that's just one stock, how I approach it. If I had a stronger AD line and this was maybe in an uptrending chart as opposed to a downtrending chart, and we had some relative strength, then I would have been looking at this a lot differently. But a stock like this has to prove to me that it's ready to go. And this really isn't proven to me anything. All right, one last thing before we wrap up. I wanted to show you, well, actually, I want to show you a couple things. Let's start with the XLK. I'm going to annotate because, again, what do we have here? Here, we actually have a down sloping neckline. Left shoulder, and that's the next thing. If you look at the left and right shoulder, what do we have? A down sloping left to right shoulder. Do you not see how this is like kind of skewed? I think a topping head and shoulder pattern that looks like this is worse than the one that we looked at on the NASDAQ 100, because this one clearly, when you have a down sloping neckline, you didn't just go down and test the prior low. You actually went below it. You broke down temporarily. To me, that's a little bit more bearish to see that the sellers had enough control to take price action down below that prior low. Because in an uptrend, you almost always have higher lows, or at worst case, maybe you go back and you test a low, but you don't put a lower low in. And then this was a very shallow move back up with very light volume to test the 20-day moving average, and then a big gap down. And look at the volume accelerate on the neckline breakdown. This is not a good looking chart, and this is 32% of the S&P 500. That's what the XLK represents. So let's get back out of here. So we know we got things not looking that great there. That's why I'm really cautious on any move to the upside. I think we could get one, but it's not like I'm going to be rushing in to jump on the bandwagon of the NASDAQ 100 right now. I got to see a little bit more, and I think probably there's going to be a lower low somewhere down the road here over the next 2-3 months where I have a better opportunity to get in cheaper into technology. And by the way, this measurement on this neck, if you compare the high down to the neckline, that from about 238 down to maybe 221, that's 17 points. So you break below 221, 17 points takes you to 204, which essentially marks this low that we saw at the end of May. So it could be that we go all the way back down there and maybe have a bigger picture head and shoulder. I don't know that that one breaks, though. I think that's probably would be the downside for me on the XLK, at least based on what I'm seeing right now. But that would be if we, make a move back up and test the breakdown here, 220, 221, that would be roughly about another 8.5% down from that rally. So we still got potentially some downside to go here on the XLK. The other thing I want to show you was small cap technology versus large cap. So if we annotate here, on the day that the CPI report came out, a lot of things changed. And small cap technology shares were doing nothing relative to large cap. They had been downtrending. Yeah, we had a couple little, rallies in here, but for the most part, small cap technology was significantly underperforming and consistently underperforming large cap tech. That CPI report came out for June on July 11th. And ever since then, it has been a straight up move on small cap tech versus large cap tech. I don't know if this continues, but watch. One thing that's been consistent about this pattern is the lower relative lows, lower relative highs. Every time we rally, we don't get back up to the prior high. This one has a chance. And this would be further confirmation, in my view, that we've got a significant small cap rally on our hands if we can go right back up and take out that last relative high. So if we keep moving up and get through that early May relative high on the PSCT relative to the XLK, that would be a really good sign for me. All right, that is it. It is 9:34, so market has opened. I do want to bring up this one chart list here. This is the upcoming earnings chart list for companies that reported yesterday after the bell or this morning before the bell. So by pulling this up, we can get a quick look at companies, all these various companies. There's a bunch of them. I think it's like, yeah, there it is, 92 of them. So we have 92 companies. Which earnings report has been treated the best at the open or in the first 5 minutes? Well, I'm going to give you an update and we're going to find out. Harmonic, HLIT. Second one, we talked about this. When did we talk about this? Last night, I guess, in our webinar that we had for Q2 earnings. I brought this one up, SFM. So this is Sprouts Farmers Market, up 21% this morning. This was a company that had been uptrending and was showing relative strength going into its earnings report. So a result like this does not surprise me at all. Harmonic we didn't look at last night. So let's pull this chart up and just see what's going on here. This one actually had just been going mostly sideways in terms of relative strength for quite a while. So this is a little bit of a surprising report. We gapped up above all the prior resistance. And actually, because we did, if we get a pullback intraday back down close to 14, might not be a bad place for entry, assuming that HLIT beat top and bottom line. Now, I'm assuming they did because of such a positive reaction, but I'd want to confirm that. If they did, moving back down maybe to test this prior high from February could be a solid entry point. The other one that I would bring up is that Sprouts. Here, look at the relative strength going into this report. Very, very strong relative to its peers. And there you go, big 20% move to the upside. No shocker for me. As far as what didn't work out last night, Symbiotic, which is down 17%. Let's see what that chart looked like. Doesn't show any history, but it did gap down below all this prior support. It's coming back up. I mean, I don't know where it goes early in the morning, but I think this has got the possibility of returning back down below that low at the open. I don't know where it turns. I'd be watching it maybe on an intraday chart if you don't mind shorting. I think as this thing rallies back, if it starts to turn on like an intraday chart, starts to roll over, that's where I might take a shot if I was planning to short. Another one, WWD. We did talk about this one last night. Here, pulling back down. And I think this one missed on one of the, I can't remember if it was revenue or earnings, but there was one beat and one miss. So I would just leave it alone. But a lot of times when companies do sell off like this and they hit a key support level, top of gap support or bottom of gap support, sometimes you'll get a quick pop back to the upside and maybe watch to see which level breaks first here on an intraday basis. Do we go back, take out the intraday high that we've seen so far or the low? We're kind of trading right in the middle of that with no real clue just yet. Anyway, let's get a quick update on the market. So we've got, I don't know, pretty much where we were in pre-market. I think maybe a little bit stronger. Dow certainly stronger because the Dow, if you recall, when I looked at it, was down fractionally. Now it's up 0.3%. S&P up 0.4%. NASDAQ a bit more than that. Small caps up around about 0.5%, which I think is about where we were. And we can see the VIX dropping a little bit, 1636. Looking at the gainers, the winners so far on the S&P 500. Not seeing any semiconductors on this list. Percentage down. GLW is interesting because I thought, we had a really good move not that long ago. I'd be interested to see what the heck happened there because I thought their earnings report was back in July, but maybe I'm wrong. Earlier in July, I thought, with the breakout. Just looking, CrowdStrike down another 15. I was asked recently about CrowdStrike, and my comment is I think you're going to get a good buy, but it could be lower. Well, it's so far lower. I would be really careful with this until you start to see a base form. Right now, it's just in sell-off mode. I'd be really careful with it. Not seeing any semis here. I was just interested to see how the semis were doing. Let me pull that chart up real quick. It's up 0.01%. So just not any significant movement. NVIDIA's down. listen, if the semis don't get going, any move up in the QQQ or the XLK, I think it's going to be minimal. I just don't think it's going without the semis. Semiconductors are 11% of the S&P 500, and they are 25% of the NASDAQ 100. So if you just keep seeing downtrend in semiconductors, it's a really big weight on the shoulders of both the S&P and especially the NASDAQ 100 and technology in particular. I think semiconductors are 50% of the XLK, 50, 5-0. So if this group isn't bouncing, that XLK is going to still remain under quite a bit of pressure. All right, that's it for me. I appreciate everyone tuning in. I'll be back. And I've had some questions about, reducing shows here on YouTube and for everyone out there. And I haven't really reduced shows. I've just done different shows. So Wednesday is the only one that really technically has been eliminated because we have a live trading room Sunday, or excuse me. No, we don't. We don't do any live trading room on Sunday. We have a live trading room on Wednesday at 10 a.m. And we used to do a show at 9 a.m. It was just a lot because that trading room, which was designed originally to go 45 minutes, I like to teach in there, and it minimally has been going at least an hour, usually an hour and a half. And the last one was 2 hours. It's just hard to do a show at 9 o'clock on Wednesday, right before I get into a lengthy trading, live trading room. So that's the reason. It was just too much, and I couldn't really adequately prepare for the live trading room when I have a show to prepare for right before it. So that's the reason the Wednesday show's gone. Thursday, I was asked to do another show over at Stock Charts. They were kind of redoing what they were kind of reorganizing after not doing Stock Charts TV anymore. And they wanted me to do a regular show once a week, and Thursday was open. So I picked that. So now I'm doing a recording with Stock Charts on Thursdays that you can find on YouTube. Normally, we've been trying to send out emails to everyone to let them know when it's ready. But normally between 12, 1 o'clock Eastern, maybe a little after 1, something like that. Actually, 12, probably not. Probably more like 1, because a lot of times I don't even get done the recording with Stock Charts until 11:30, 11:45, and there's just no way to turn it around that quick. But look around 1, maybe between 1 and 2. You can just go to YouTube and search me and Stock Charts, and should come up as soon as that is available. And then just make sure you subscribe and turn on your notifications, and then you'll know every time as soon as it's published. But anyway, once I added that, it didn't make a whole lot of sense to have 2 shows on Thursday, especially one that's all encompassing like I do on Thursday. So make sure you check that out. It's not like the show went away. It's just delayed. It comes out a little bit later in the day. I'm still doing a weekend market recap if I'm in town. And I'm in town probably 90% of the weekends throughout the year. So there might be a handful of weekends where I go off on a golf trip or something. I'm out of town. Okay, I might not have one that weekend. But for the most part, I do these every weekend. And I'm also doing these one-offs videos every once in a while, trying to do at least one a week. Trying to remember the last one that I did, what it was about. But anyway, you can pull those up as well. Make sure you subscribe to our YouTube channel here at Earnings Beats. And then anytime we do any kind of a recording, you'll be notified. Make sure your notifications are on. So like the video, subscribe. Just wanted to explain a little bit. I still am out there a lot with a lot of content for everyone to check out. So I know, sometimes it looks like, hey, we're not doing what we were doing. Well, it's just that we're doing things a little bit differently. That's all. Still putting out a lot of information out there. So with that, I'm going to be done. But again, if you sign up for that trial, you'll be invited to our live trading room tomorrow. In fact, 30-day trial gets you 5 weeks of our Wednesday live trading room. So great reason to go over to Earnings Beats, and at the top, click on that green button, start your no-cost trial today. And check us out over the next 30 days. Anyway, have a great rest of your day, everybody. And remember, Fed meeting today and tomorrow. Tomorrow at 2 o'clock, get ready. Fireworks. We got big earnings reports coming out the next 2-3 days. Microsoft, Apple, Meta, Amazon. Don't get much bigger than those. And then we've got ADP employment report on Wednesday, non-farm payrolls on Friday. I mean, put on your crash helmet and get ready, because I don't know exactly which way this market's going, but I do know we're going to get a lot of information to feed off of. Have a great day, everybody. Happy trading.